Banks, financial institutions and lenders have a standard approach to determine a business capacity to repay its debt obligations. Learning objective. In this module, you'll learn what debt service means, how to calculate it, and what banks consider as a healthy repayment ability. This is a critical element in your loan approval journey. Imagine this: you apply for a bank loan for Rm 100,000. The bank says, "Let's check your debt service capacity." What does that mean? It means they want to know, can you afford to repay this loan every month without running out of cash? This is where debt service comes in. What is debt service? Debt service is the amount of cash flow a business has available to meet its loan obligations, usually monthly installments that include principal plus interest. The bank calculates whether your income is enough to comfortably repay the loan, while also keeping your business running. Key metric: Debt Service Coverage Ratio, DSCR. One of the most important numbers banks look at is the DSCR, or Debt Service Coverage Ratio. Formula: DSCR equals net operating cash flow divided by total debt obligation. Note: total debt obligations here refer to all loan repayments that includes principal plus interest. For example, if your business generates Rm 15,000 net operating cash each month, and your total monthly loan repayment is Rs 10,000. DSCR equals 15,000 divided by 10,000 equals 1.5. That's a DSCR of 1.5. Meaning you have 1.5 times the cash needed to repay the loan. That's good. What is a healthy DSCR? DSCR value meaning interpretation. A DSCR that is below 1 means the borrower or business is simply unable to repay the debt obligation. What does this mean? It will be very challenging for the bank or lender to approve your loan and will be likely declined. A DSCR of 1 to 1.1 is marginal but by all means still acceptable. DSCR of between 1.2 to 1.5 signifies healthy and bankable repayment capacity. Anything above 1.5 represents comfortable and strong repayment capacity. Tip: aim for 1.2 and above to strengthen your chances. How do you calculate net operating cash flow? Note: please note the difference between DSCR for calculating personal financing versus business financing. Remember from the formula, net operating cash flow, income divided by total debt obligations. Net operating cash flow or income can be obtained from either the profit and loss statement or bank statement. Method 1. From profit and loss statement, EBITDA, earnings before interest, taxes, depreciation and amortization. Method 2. Using bank statements. Bank statements look at actual cash inflows and outflows. Many banks, financial institutions can replace net operating income with 1. Average monthly bank deposits in the last 6 months factored with industry income factor, or estimated profit margin of the industry. 2. Average cash balance for last 6 months. Example calculation: let's say, from the profit and loss statement A, net profit equals Rm 8,000 B, depreciation equals Rm 3,000 C, interest expense equals Rm 1,000, net operating cash flow equals 8,000 plus 3,000 plus 1,000 equals Rm 12,000. Total loan repayment equals Rm 10,000 per month, obtained from adding all existing and additional debt commitments, all installments and principal plus interest. DSCR equals 12,000 divided 10,000 equals 1.2. This is a healthy and acceptable DSCR. Why this matters to banks? Banks don't only look at your profit. They want to know whether your cash flow supports loan repayment even if sales are slow or expenses rise. They will ask, do you have sufficient buffer? What if sales drop 20% next month? Are you relying on a single client? A low DSCR equals higher risk to the bank. Tips to improve debt service capacity: increase revenue, offer upsells or better products, reduce expenses, audit unnecessary costs, restructure existing loans, reduce monthly burden, inject capital, put in owners' funds or equity, stabilize cash flow, use recurring payments or subscriptions. Some mistakes to avoid: relying only on net profit, without cash flow analysis, overestimating your repayment ability, not knowing your own DSCR, taking multiple loans without checking affordability. Final thoughts: debt service is about discipline, visibility, and responsibility. Know your numbers. Track your monthly inflows and outflows. Calculate your DSCR before applying for a loan, not after. Remember, you don't get loans because you need money. You get loans because you can show you can repay them.